Hi everyone, you're at the front of finance. This is the course Investing 101, Part 1 Money and How It Attains Its Value. Let's get started. So to understand money as a whole, we have to first understand how money even came to being in the first place. The first thing was the barter system. This system involved two people that exchanged items in order to attain a desirable commodity for themselves. An example would be a farmer that traded 10 potatoes for 10 eggs from another farmer. However, the issue with the system that arose was that it ultimately became difficult for both parties to agree on the quantity and value of the products being traded. It became difficult for both farmers, in this case, to come up with an agreement of how much of which product should be traded. And so the solution of a more liquid form of money was needed. If you're not familiar of liquid and liquidity as a concept as a whole, a commodity is said to be liquid. When a commodity is said to be liquid, we mean it can be quick and easy for this commodity to be converted into something of value. In this case, cash. In the present day, it's cash. But in that time, that something of value is commodity money. So commodity money then came to being. Commodity money is basically money that is backed by some sort of commodity which gives it value. It has utility or usefulness in other applications beyond just its use as money. Even if no one accepted such goods as trade, the owners could still use these goods for their purposes. So examples of commodity money that were used back then were cocoa beans, salt, tobacco, seashells, which at some point were actually used as a currency. So an example in the current day is silver and gold coins. So silver and gold have other purposes beyond just their use as money. Gold can be used in jewelry, for example, in electronics or other industrial applications. And that's when paper money came to being. Basically, for convenience sake, paper money was invented, reducing the need to carry around heavy and cumbersome metallic coins or salt or cocoa beans to the shop to conduct transactions. And this paper money is either backed by gold or silver certificate or the word of the government. So, what gives money its value? The value of money is derived from the relationship between supply and demand. Beyond just the basic supply and demand law that's made by economics, which is that when supply is more than demand, then the price will reduce, and when demand is more than supply, then the price will increase. But if we apply this same law to money, we can understand that when supply of money increases to the point that it's more than demand, there will be more money in circulation, and this thus causes the value of money to decrease. And when the demand for money increases, when it's more than supply, there'll be lesser money in circulation, and therefore the value of money increases. The value of money is determined by its issuing body, and in most cases is the central bank of a country. And in India, it's the Reserve Bank of India, and in the US, it's Federal Reserve. So other factors that affect the value of money include economic stability of the nation, political affairs, level of inflation, and even investment conditions. So there's a way to measure the value of money. So the value of money is measured using various economic indicators. And a common method is exchange rates. In this, the exchange rate is basically a way of representing the value of one currency relative to another, which is usually the USD, which is the US dollar. So exchange rates, if we relate this back to the previous slide of the law and supply demand of money, we can understand that exchange rates fluctuate based on supply and demand dynamics in the foreign exchange market and thus provide an indication of the value of currency. Let me introduce you to the fact that money is a mode of payment that can be used to acquire assets or repay liabilities. If you're unfamiliar with the terms assets and liabilities, don't fret because I will explain it. It's quite simple actually. So assets are basically assets or items that put money into your pocket. It's a resource with an economic value owned by an individual or a business, for example, that has a future benefit. On the other hand, a liability is something that takes money out of your pocket. It's an obligation or a debt owed by an individual or a business. So if you want to take 2 minutes out to pause the video and try and guess what these 5 items below on the screen, whether they would be assets or liabilities, based on your current knowledge of assets and liabilities. There's a hint that they can be both of them at the same time too. So a loan would be an asset. Although a car is a depreciating asset meaning that its value decreases over time, it still retains some amount of worth. So the salvage or residual value of the car after depreciating still has some amount of worth, and so it can still be converted into cash and thus can be defined as an asset, which is, after all, bringing money back into your pocket. A loan is a liability. So for example, if a business is running low on capital and they have to find a source of finance, and they chose loan capital. But even though this provides short-term capital, it still poses a liability to the business, because this amount of loan that you have taken from a bank or a person or whoever you took this loan from has to be repaid back by you, and along with the interest that comes with this loan. A child, if you want to take a child in the view of an asset or a liability, we can do that. It's actually quite a good example. So a child, when young, they're usually considered liabilities because you need to care for them, you need to pay all their expenses, their healthcare, their education, and protect them at all costs. But in the later season of their lives, when they've reached adulthood and are ready for work, they're money-making individuals, they will then become assets to you. Assets to you as a person, as the parent who has retired and does not earn for themselves anymore. Your son or your daughter is an asset to you because a portion of their income comes to you back into your pocket. So they're an asset to you. So an asset or a liability, in the case of a home, it's contextual. And this can be the case with many other items. So if a home is a mortgage, which is basically a type of loan used to purchase a home, a plot of land, or any other types of real estate, it would be a liability because, again, it's a type of loan. You have to pay it back. You have to pay back the interest back. But if it's not a mortgage, then the house would be a tangible or physical asset. A physical asset is basically an asset that's not liquid. So a house appreciates over time, and hence selling the house, for example, would thus again bring money back into your pocket. And the last are stocks. Stocks are financial assets, which is a type of liquid asset. And like I mentioned before, a liquid asset is something that can be quickly and easily converted into cash. So an investor buying stocks or a share becomes a part owner of a company that has sold these shares to somebody. So if you buy a share that's $100,000 and it increases to $150,000, and you sell this $150,000 share, you earn some amount of profit, and this money goes back into your pocket. So again, it's an asset. That's the end of this lesson. I hope you learned something new, and please attempt the quiz at the end.